Welcome to the Deep Dive. We're the show that cuts through the noise, giving you, our savvy investor audience, the insights you need. Today, we are really digging into Occidental Petroleum. Ticker's OXY. And look, this isn't just another big energy name. OXY is, well, it's a fascinating company, a traditional oil and gas player making some really bold moves towards the future. And maybe most famously, it's caught the eye of Warren Buffett in a big way. So our mission today, it's pretty straightforward. We want to equip you, the American investor, with a really solid, professional, multifaceted analysis of OXY. Think of this as your shortcut, your way to really understand what makes this company tick its financials, the market forces, the risks, the opportunities, basically everything you need for informed decisions.
Yeah, and to do that, we've really gone deep into the source material. We've pulled together everything from OXY's own reports, the latest financial data, industry forecasts, market sentiment, the whole picture.
Okay, let's unpack this then. For those of us thinking about an investment, who exactly is Occidental Petroleum? Beyond just OXY, what's the core business here?
Right, so at its heart, OXY is a U.S.-based international energy company. It really stands on three main pillars. First, and this is the big one, is their oil and gas segment. They are a major force here, especially, and this is critical, in the Permian Basin.
The Permian, yeah, that's huge for U.S. oil.
Absolutely. It's over half of U.S. production, and OSY is one of the largest operators there. I mean, back in 2020, something like 77% of their global production came just from their U.S. operations, heavily weighted towards the Permian. They're also active in places like the DJ Basin, the Gulf of Mexico, and internationally to Middle East, North Africa.
Okay, pillar one, oil and gas. What's next?
Pillar two is their chemicals division, OxyChem. This part makes basic chemicals, think chlorine, caustic soda. Now, this isn't just some side business. It's actually quite strategic. It acts as a kind of hedge.
A hedge. How so?
Well, it provides a buffer against that wild energy price volatility we all know about. You know, when oil prices take a dive, the chemical business can often provide more stable, predictable revenue. It smooths things out a bit.
Interesting. Okay, so oil, gas, chemicals. What's the third pillar?
Third is midstream and marketing. This is all about logistics and adding value across the chain. They handle purchasing, marketing, gathering, processing, transporting, storing, basically managing the flow of crude oil, natural gas liquids, NGLs, natural gas, even CO2 and power. It optimizes everything. And there's a fourth area that's increasingly important, really forward-looking: carbon capture, utilization, and storage. CCUS.
Ah, yes, the carbon capture angle. We hear a lot about that with OXY.
Exactly. They're actively investing, quite heavily actually. They use CO2 for enhanced oil recovery, or EOR, which, gets more oil out while storing the carbon. But it's more than just EOR. They're looking at it as a real long-term growth driver and, frankly, a crucial part of their response to ESG concerns and environmental, social governance factors.
That's a pretty clear picture of the moving parts. But, the energy sector is crowded. What makes OXY stand out? What's their edge for an investor?
That's a great question. They've got several distinct advantages, I think. First and foremost is that Permian Basin leadership. They have vast assets and decades of operating experience there. In the biggest U.S. shale play, that translates to efficiency, stability, a lower cost base. That's a serious leg up.
Okay, Permian strength. What else?
Second, that diversified business portfolio we just talked about. The oil and gas plus chemicals mix. That really does help balance things out. The chemical side acts like a financial ballast against those energy price swings. It makes them potentially more resilient than a pure exploration and production company.
Makes sense. And you mentioned Buffett earlier.
Right, and that's the third unique factor: Warren Buffett's support. Berkshire Hathaway holding nearly 27%. That's huge. It's more than just money. It's a massive signal of confidence from arguably the world's most respected long-term investor. His involvement, his buying or selling, it really influences how the market views OXY.
Okay, that leads us nicely into the numbers. Let's talk financials. How has OXY actually been performing, and what metrics should investors really zero in on?
Yeah, the numbers really show that link to oil prices we discussed. If you look at the trailing 12 months ending, say, March 31st, 2025, revenue was around $27.5 billion. Now, 2024 revenue was actually down a bit from 2023, about 5.4%. But then Q1 of 2025 saw revenue jump almost 14% year over year, although, interestingly, it slightly missed analyst estimates for that quarter.
So up year over year, but missed expectations. Volatile, like you said.
Exactly. The top line really dances to the tune of oil prices. Profitability shows a similar pattern. Net income took a big hit in 2024 compared to 2023, down almost 29%. But then first quarter 2025 earnings per share, the EPS, actually beat the consensus forecast. That was a nice little earnings
It
surprise.
suggests maybe good cost control or catching a price updraft.
Could be either, or both. But the key takeaway is the expected EPS range for all of 2025 is pretty wide, from like $2.26 to $3.85. That just screams volatility linked to energy prices.
Right. What about cash flow? That's always critical for these capital-intensive energy companies.
Absolutely critical. We focus on free cash flow, FCF. The expectation is for FCF to pick up again in the second half of 2025. Now, there are some concerns floating around about high capital spending, CapEx, and maybe higher taxes potentially squeezing that FCF in the short term. But the bigger picture on financial health is improving. Remember that huge debt pile from the Anadarko acquisition?
Yeah, that was massive.
Well, they've been really aggressive paying it down, helped massively by stronger oil prices recently. So the balance sheet is definitely looking healthier. They're getting more financially sound.
Okay, improving balance sheet, volatile, but sometimes surprising earnings. How does this translate into valuation and shareholder returns? What should we watch there?
Good question. Looking at valuation, the price-to-earnings ratio, or PE, gives some context. Trailing 12 months, it's around 18. Forward-looking, based on those 2025 estimates, it dropped to maybe 12.5 times earnings.
And how does that stack up?
Well, it's significantly lower than the overall S&P 500 average, which is up around 26 times. It's generally kind of in line with its energy peers, maybe slightly favorable depending on who you compare it to. Their EV to EBITDA multiple is also pretty reasonable, around 4.8x. Profitability metrics like return on equity, ROE, and return on invested capital, ROIC, are looking decent too, around 9.5% and 6.4% respectively as of mid-2025. Shows they're using capital reasonably well.
Okay, and for income investors, the dividend is key, right?
Always. OXY just announced a $1.24 quarterly dividend per share. That gives it a current yield of about 2.2%.
Which is lower than it used to be.
Much lower than the highs back in 2019, 2020, yeah. It's crucial to remember the history here. The dividend growth rate looks fantastic over 3 years, like 77%, but it's deeply negative over 5 and 10 years.
Because of the cut during the pandemic.
Exactly. Oil prices collapsed in 2020, and they had to slash the dividend. But the good news now is the estimated payout ratio for 2025 is around 36%. That's pretty comfortable. Suggests the current dividend is sustainable, assuming energy prices cooperate. And don't forget share buybacks. That's another way they return capital to shareholders when cash flow allows.
Okay, this is where it gets really interesting for me. What actually moves OXY's stock price day to day, quarter to quarter? Let's break down those levers, starting right inside the company itself, the micro-level factor.
Right, the micro-level stuff. Company-specific news. First off, those quarterly results and guidance. Like we saw in Q1 2025, the EPS beat was good news, the revenue miss, maybe less so. Everyone will be watching the Q2 results on August 6th very closely, and their production targets matter too. They're aiming for around 1.4 million barrels of oil equivalent per day for 2025.
And you can't talk micro without mentioning
Warren Buffett, absolutely. Berkshire Hathaway owning almost 27%. Any move he makes, any filing showing buying or selling, it gets huge attention. The stock dipped about 15% in the first half of 2025, but the fact that Buffett is still holding such a massive stake provides, well, a psychological floor for many investors.
What about that carbon capture stuff? Is that actually moving the stock yet?
Increasingly, yes. The low-carbon business and CCUS progress is becoming a real factor. Things like the recent joint venture with 80NOC XRG for that big direct air capture hub in Texas, or getting key permits for their Stratos facility. These aren't just press releases. They show tangible progress, position OXY for the future, and importantly, attract ESG-focused investors. Plus, they've made real cuts to their own emissions. Scope 1 and 2 greenhouse gases down over 20% since 2019. That matters.
Okay. And dividends and debt.
Definitely micro drivers too. That $1.24 dividend signals stability. And positive news on debt reduction, like they announced back in February, shows improving financial flexibility. If free cash flow improves, investors will look for potential dividend increases or more share buybacks. These all directly impact sentiment.
We've drilled down into the company. Now let's zoom out just a bit. How does the wider industry, energy, chemicals, shape OXY's performance?
The meso level, right?
Exactly, the meso-level industry context. The Permian Basin production outlook is huge here. Projections show Permian output hitting maybe 6.6 million barrels a day by late 2025. driven by drilling efficiency. As a top player there, OXY rides that wave directly. More Permian production is generally good for OXY.
And the chemical side, OxyChem.
Yeah, global chemical industry trends impact that segment. They actually lowered their 2025 guidance recently. Why? China's economic slowdown, high U.S. interest rates hitting demand. Even though we've seen some recent small upticks in prices for things like caustic soda, it's a reminder that even the hedge segment feels global economic pressures. Makes sense. What about the carbon capture market itself?
That's another key mesofactor, the carbon capture and storage CCS market growth. Forecasts showed this market growing significantly, maybe doubling from around $3.3 billion in 2024 to over $6.3 billion by 2029. This directly validates OXY's big bet on CCUS as a long-term growth area and helps them manage those ESG risks we talked about.
And competition. They're not alone out there.
Definitely not. The competitive environment matters. They're up against giants like ExxonMobil, Chevron, other big independents like ConocoPhillips, EOG. On the chemical side, think Dow, LyondellBasell. But again, OXY's Permian strength and that diversified model give them specific advantages within that competitive landscape.
And zooming all the way out now, the big picture. What macroeconomic forces, global trends should an American investor keep tabs on when thinking about OXY?
Okay, the macro level. This is often the most powerful influence, honestly. Number one, without a doubt, global oil and natural gas prices. Right now, Brent crude is maybe $68 a barrel, WTI around $65. The US EIA forecast Brent averaging about $69 for 2025, but then dropping quite a bit to $58 for 2026. Natural gas prices look set to rise, though.
And OPEC Plus.
Crucial point. OPEC Plus announced they'll start increasing production in August 2025. That could definitely put downward pressure on prices. This is the most direct hit to OXY's revenue and profits, up or down.
What about interest rates, the Fed?
Yes, the U.S. Federal Reserve's interest rate policy. The Fed held rates steady in June 2025, around 4.25, 4.5%. They project cuts down to maybe 3.5, 3.75% by the end of 2026. Generally, rate cuts are good for energy. They can boost investment, potentially lift commodity prices. But if inflation stays sticky, the Fed might cut slower, which could dampen that effect. It's a balancing act.
And the overall global economy.
Yeah.
Growth, inflation.
It's also critical. The global economic growth and inflation outlook. The IMF sees steady global growth around 3.2% for 2024 and 2025. Strong growth means more energy demand, which helps OXY. If inflation stays high, OXY might be seen as an inflation hedge. But the flip side is a global slowdown would crush energy demand. So it's a double-edged sword.
Any other big macro risks?
Geopolitical risks,
Oh.
always a factor in energy. Instability in the Middle East, the Russia-Ukraine war, political situations in major oil countries.
Yeah.
These create supply uncertainty. That can spike oil prices short-term, which might seem good for OXY's bottom line, but also increases the risk of a global recession, which would hurt long-term demand. So it's complex.
Okay, every investment has risks. We've touched on some, but let's focus specifically on the key risks for an OXY investor, and then what internal strengths help them manage those.
Right. Important to face the risks head-on. The biggest one, we have to keep saying, it's volatility of crude oil and natural gas prices. It hits everything. Revenue, profit, cash flow, their ability to pay and grow the dividend. It's the fundamental risk.
Beyond prices.
Regulatory and environmental ESG risks are significant and growing. Stricter carbon rules, methane reduction targets, potential land restrictions. These can increase costs. And the whole ESG investment movement could potentially make it harder or more expensive for traditional energy companies to access capital over time.
What about their focus on the Permian? Is that a risk too?
It can be. That geographic concentration risk means if something specific happens in the Permian, a natural disaster, unique local regulations, it hits OXY disproportionately hard because they're so heavily invested there. Also, the constant need for reinvestment, that high capital expenditure burden, drilling wells, building infrastructure, it costs a lot. Funding that CapEx becomes a real challenge if energy prices are low for a prolonged period.
And the dividend history we discussed.
Yeah, that past dividend volatility is a risk factor for income investors. The 2020 cut is a stark reminder that the dividend isn't guaranteed if the market turns sharply south. Sustainability needs constant monitoring.
Okay, that covers the risks. It's easy to get bogged down there. But OXY isn't just passively facing these, right? What are their internal strengths, the capabilities they use to navigate this?
Absolutely, they have real strengths. We mentioned their Permian Basin operational expertise. Decades of experience translates into efficient drilling, getting more oil out for less cost. That operational excellence is a huge internal asset, especially when prices are lower.
And the business mix.
That integrated business model, Oil, gas, chemicals, midstream gives them flexibility. The different parts can offset each other to some degree, and the chemical segment really does provide that natural hedge we talked about.
What about the future-facing stuff?
Their leadership in carbon capture technology is a major strategic strength. They are genuinely pioneers in CCUS, especially direct air capture. This isn't just talk. It positions them for competitiveness in a lower carbon future. It's their big bet on staying relevant.
And the balance sheet.
The progress there is key. Their financial health improvement efforts since Anadarko have been successful. Reducing debt gives them much more flexibility now for investment, for weathering downturns, and for returning cash to shareholders.
Sure.
That's a big internal win.
Anything else?
I'd point to management, vision, and execution. CEO Vicki Hollub and her team have laid out a clear strategy, particularly around the energy transition and CCUS. They successfully managed the post-Anadarko debt and integration. Strong, focused leadership is definitely an internal capability.
This has been incredibly thorough, a real deep dive into Occidental Petroleum. We've covered the business model, the financials, all those drivers from micro to macro, the risks and the strengths. It really paints a picture of OXY as a major energy player, yes, but one with significant assets and, crucially, a very deliberate, forward-looking strategy focused on carbon capture.
Absolutely. And for you, the American investor listening, the final piece of advice is really this. It comes down to your judgment, your view on future oil prices, your personal tolerance for risk. Yes, Warren Buffett's huge stake is a powerful endorsement, no doubt. It shows his conviction in their long-term value. But please, don't just blindly follow. Do your own homework. Use this analysis as a starting point. Keep monitoring OXY's financial health, especially that debt and cash flow. Watch the dividend sustainability. Track their progress on those low-carbon initiatives. And always, always keep an eye on the global energy market. Understanding all these layers is key.
What a journey into Occidental Petroleum. It really underscores how companies in these traditional sectors are navigating change, adapting, and placing some pretty significant bets on where the future of energy is heading. Fascinating stuff. If this was helpful, please subscribe.